Financial Modeling, Topic 15, Option Valuation and Hedging, Section 4. We're going to value option using the Black-Scholes model. Now, the Black-Scholes model, or also called the Black-Scholes formula, is simply a closed-form formula to compute the value of a call or put using the same assumptions of normal distribution and stock returns, normal distribution of stock returns, and the random walk model. So it has the same assumptions as the Monte Carlo model we just did in the previous section. Now, Black-Scholes is the standard model used by market participants, traders, for valuing plain vanilla European style calls and puts, even though the assumptions of normality and the assumption of a known and constant standard deviation or volatility are widely criticized. There's also been a lot of studies that show that these Black-Scholes prices are pretty close to the market prices of the options. Here is the Black-Scholes formula. Now, this formula was developed in the 1960s and 70s by researchers Black and Scholes, and then later another researcher helped finalize the formula, Bob Merton, so sometimes it's also called the Black-Scholes-Merton model. Here is the formula, a simple formula for calculating the value of a call and the value of a put. Now, understanding this formula is beyond the scope of this book. I'd recommend some other books on deriving that formula, but I'll just give you some intuition into this formula. Otherwise, we're just going to be a user. This function is called BS call. The parameters are current spot price, strike, which uses K, volatility, the annualized standard deviation of the asset returns, the risk-free rate, same maturity as the option, the maturity of the option in years, and the dividend yield. And this model first calculates something called D1, which you can see the function is the natural log of S over K. So it's kind of the relationship of the current spot price and the strike. And this kind of looks like our random walk formula. So it's kind of like the expected return to the stock, or return to the stock, assuming it's growing by the risk-free rate. And then here's the factor of the volatility. And this is basically calculating the probability. One way of thinking about this formula here, ND1, it's kind of the probability that the stock winds up in the money. And then it calculates ND2, which is roughly the probability that winds up out of the money. The derivation of the formula is beyond the scope of this lecture, but you can think of D1 and ND1 and ND2 as kind of the probabilities of the stocks being in the money at maturity. And then the value of the call depends on those probabilities, the spot price, and the strike price, and has some present value factors in the dividend yield there. And the same for the put, except for the put, you can see it's strike minus the spot versus spot minus the strike. So these are the Black-Scholes formulas. So you don't have to iterate a bunch of random numbers. You can simply take this function, insert it into your spreadsheet, and get that valuation. So I'll go ahead and do that. I'll go to my spreadsheet. I've already put those formulas in VBA. So to do that, all you have to do is insert a module into your spreadsheet and paste those in there. And now I'll just go ahead and use those functions. I'm going to delete these two question marks. I'm going to do an insert function, user defined. There's BS call. And I'm going to put in the current spot price, 614. I'm going to anchor everything. The strike price of the option, 615. Anchor that using F4 key. Volatility, 30%. The risk-free interest rate of 10 basis points. Anchor that. The maturity of this option, 0.049 years. And the dividend yield of 0. Anchor everything. I'll hit OK. And notice, voila, the Black-Scholes price is equal to that Monte Carlo simulation, and I didn't have to run the 10,000 iterations. If I copy this formula down and change that to BS put, I now have a put price for the option. Whoops, must have misspelled that. Let's try that again. I'm going to just change that BS call to BS put. And there you go. 1668, using both the Monte Carlo and the Black-Scholes. For those of you who didn't see the earlier lecture, you could simply take this code, copy it from Excel or my PowerPoints, or just type it in, go back to your spreadsheet, hit Alt F11 to get into the VBA editing area, insert a module, and then paste the formulas in. There's my BS call, there's my BS put, and then you can use them in that spreadsheet. If you're going to value currency options, so say an option on Australian dollar, I'll just say there's one little fix to the Black-Scholes formula to handle currencies, and that is you can put in the spot price of the currency, say the Australian dollar is trading for 89 cents a dollar, put in the strike price, say 90 cents a dollar, put in the interest rate, the risk-free rate, the U.S. interest rate, risk-free U.S. interest rate for the maturity of the option. There's this maturity of this option. Put in the volatility of the currency's appreciation or returns. The last thing you have to do, one adjustment you have to use for applying Black-Scholes to a currency is where it says dividend yield. Put in the foreign country's risk-free rate of the maturity of the option. So in this case, the Australian interest rate was 2.5%. For 10 months, so I put 2.5% in the dividend yield. And the reason why this makes sense is if you own a stock, you receive a dividend. If you own a currency, you deposit it in a foreign bank and earn that return. And if I put in my Black-Scholes formula for the call and the put, what you'll see is that this call on this Australian dollar should be selling at 2.1 cents for each call, and 0.047 cents for each put on one Australian dollar. Another caveat, when using this model, you always have to put in direct prices for both the strike and the spot. If you're valuing, say, a Mexican peso currency, and say the Mexican peso is trading at, say, 20 pesos per one US dollar. Well, in this model, if that were the strike, and the spot price, I'd have to put, say, 1/20th to convert this into dollar prices. So I have to put a nickel basically in here. Make sure that these are dollar quotes of the currency, both in the spot and the strike. If I were going to do the yen, or the Japanese yen, if the yen is trading at 100 yen per dollar, I would convert that to 1 cent per yen, and I'd put 1 cent here for the strike and spot if that were the case. So in this case, I've calculated the Black-Scholes valuations for calls and puts and talked about how to amend that formula or use that formula for the pricing of currency options.